Hey everyone, welcome back to Corporate Decoder. Today we're diving into Equity Bancshares' latest 10Q filing. It's like looking under the hood of their financial engine, and trust me, there are always a few surprises you can find. Today's filing has a few interesting shifts in how they're managing their debt and, well, how they make sure they don't have to pay taxes. Before we start, if you enjoy getting straight insights from corporate documents, make sure you're subscribed and hit that notification bell. We also have a Discord community linked in the description below so you can join the conversation with other finance enthusiasts. Think of Equity Bancshares as a community bank chain like your local hometown bank, but expanded across Kansas, Oklahoma, and neighboring states. This 10Q gives us a quarterly update. Let's see how they're doing. First, some basics. This Form 10Q is for the quarterly period ended March 31, 2025. The company's commission file number is 00137,624, and as of April 30, 2025, they had about 17.5 million shares of Class A common stock outstanding. Let's jump to the good stuff. The financials. Total assets are up from $5.33 billion to $5.35 billion. Where's that growth coming from? Well, cash and due from banks increased significantly from $383 and $431.1 million. This means Equity Bancshares has more readily available money. That's generally a good sign that they can easily handle day-to-day operations. Loans net of allowance for credit losses increased from $3.46 billion to $39 billion for NBID dollars. Inkiv and Inai on that risk later. On the liability side, demand deposits are slightly down from $954.1 million to $949.84 are the more cost-effective funding you have for your assets. Time deposits or CDs saw a jump increasing from $736.5 million to $8041.5 million means they are potentially paying more for those deposits since time deposits are more expensive than basic checking or savings accounts. Alright, let's scroll down to the income statement. Total interest and dividend income increased from $71.80 million to $74.7 million. Higher income is always nice. Interest expense also went up from $27.66 million to $24.4 million. That's a huge jump in interest income, but interest expense decreased as well. The provision for credit losses, that's the money they're setting aside for potentially bad loans, increased from $1.0 million to $2.70 given current trade and economic uncertainty. Non-interest income is a mixed bag with some increases, some decreases. Net gain on acquisitions is zero compared to last year's $1.24 million. Non-interest expense tells an important part of the story for the quarter. For the 3 months ended March 31, 2025, non-interest expense totaled $39.1 million compared to the same period last year of $37.2 million to $20.37.20 and went up from $18.1 million to $20.37.2 million to $20.0 to 2025. Non-interest expense totaled $309, up from $18.1 million to $20 a year, $37.2 million. FDIC insurance increased a bit from $571K to $630K. This is not material, but let's keep an eye on this expense for future reports to monitor any potential increase. Finally, basic earnings per share decreased from $0.91 to $0.08 of provision for credits losses means less income, resulting in bad profitability ratios. Let's scroll into the statement of comprehensive income to check this out. So they had other comprehensive income this year compared to a loss in the previous year. This comes down to unrealized gains on securities that are available for sale. This is a classic example of how a company can boost its equity without actually making money. ARCO isn't quite real until the securities are sold and the gain is locked in. As a publicly traded company, we need to know if they are giving cash back to shareholders. So let's scroll down the statement of stockholders' equity to check that out. Okay, we can see dividends are happening. Looks like they were 31 through Fierce this year and Narvana 15s this year. That's a 25% raise in dividend for investors this year. That's a 25% raise in dividend for investors. Okay, let's scroll down to the cash flow statement and check it out. Net change in cash and cash equivalents increased significantly from $44.41 million to $47.66 million. This increase is caused by more activity and proceeds from FHLB term advances and $7 million to FHLB term advances. Okay, the financials look stable enough. Let's take a look at the notes. Tax credits are where it's at, huh? Also, this company is a wizard at minimizing taxes, so no worries there. Looks like they are hedging some of their bonds. Loan quality is very important. Let's check for it, as well as their credit risk. It appears that we are at the legal stuff and risk section. Nothing to see here. Let's skip these. Let's check out their fair value measurements. You'll hear fair value a lot, and for good reason. It means if they were to sell today, that's the actual price. Okay, that's it. Let's wrap this up. Arcti. Equity bank shares seems to be holding its own. They are a slow and steady eddy, but are they too slow? Are they going to get killed by all the fintech and high interest rates coming? The bank made $15 million for the quarter, but if you compare that to its $5.4 billion in assets, that's nothing impressive from a return on assets perspective. But management is very competent and understands their customer base really well, so it's a bit hard to bet against them if they aren't making bad loans, they're managing their capital. If you're a shareholder, keep a close watch on those expenses and any big economic changes in Kansas, Oklahoma, and neighboring areas, as well as changes to trade policy. That said, if you appreciate banking and finance, equity bank shares may be the right investment. Anyway, that's equity bank shares in a nutshell. Remember to do your own research and not just depend on me. And thanks for watching. Hit the like button and subscribe if you enjoyed. Also, the Discord link is in the description for you to join. See you all in the next video.